Hey, what it do, world? Welcome to Market Banter. This is the people's financial show. We do it for y'all. We get the best guests, the smartest people, and today is no different, but in fact, we've taken it up a level. I have with me Zach Griffiths. He is a rate strategist at Wells Fargo Securities, and Jurrien Timmer. He is the director of global macro at Fidelity. Gentlemen, welcome to Market Banter.
Thanks for having us.
Yeah, you know what? Let's just jump right into it. We're not going to mess around. We're not going to, have any small talk. The President Biden this morning outlined, and it's a rough outline, but $2 trillion in stimulus. That's the first of what's supposed to be two of these infrastructure bills. I've been hearing a lot of excitement from the economists I talked to, but from a market's perspective, Zach, I want to talk with you. We've obviously seen over the past month or so the 10-year yield going crazy. What's your expectation, and how are you viewing this announcement from the president today?
Yeah, it's definitely interesting to get a little insight into what he has planned, and the overall size at around $2 trillion is certainly a big deal. But when we think about the infrastructure package relative to something like a COVID relief bill, we think that the economic and certainly the market impact is going to be much longer term. And when you think about a COVID relief bill, that's spending that's not accounted for with tax increases or offsets anywhere else, and that really increases the very near-term budget deficit and has much bigger implications for Treasury issuance, and therefore we see that as more important for the market and a bigger driver for higher yields. And that's certainly what you've seen over the past couple months with the passage of the American Rescue Plan. And when we think about the infrastructure package, we do think it would be a good thing for the economy longer term. But as far as its near-term implications, it's much smaller than something like a COVID relief package that we've gotten a couple times over just the past 4 months or so.
Jurrien, what's your thoughts?
Yeah, so I think the market, is obviously always very, very quick to discount whatever is changing in the world. And of course, with the 1.9 trillion fiscal, we are now at more than 5 trillion cumulative since the pandemic started in terms of fiscal relief / stimulus.
Right. Not even counting this proposed infrastructure bill, right?
Exactly. So if we get another 2.5, and who knows what it exactly will look like, but it'll probably be something fairly big. We're looking at 30 to 40% of GDP in the span of maybe a year and a half. And, I like to think big picture, because I think the markets are very efficient in pricing this in. It's no accident that the 10-year yield has backed up from, 50 basis points a year ago to 1 3/4 now. Half of that's is inflation expectations. Half of it is real rates, and especially the real yield part of it, I think, is something we need to watch very, very carefully. But when I think about bigger picture, about the growth to value rotation, the backup in rates, the backup in the term premium, inflation expectations, I think we're just entering a whole new regime, right, of large fiscal expansion, not coordinated in the overt sense, but complemented or absorbed by very accommodative monetary policy.
Complemented.
And I think of it almost, like I think the Fed normally has a dual mandate, and I'm sure, it still thinks that it does. But I think closing that unemployment gap, I think is kind of the priority both for the administration in Washington as well as the Fed. And that's a whole different ballgame. And it does keep bringing me back to the analog of the 1940s, where we had obviously the buildup of World War II, different scenario, different set of circumstances. But still, we had a massive increase in the federal debt, and it was monetized by the Fed, which was not independent yet. That happened in 1951. Short rates and long rates were capped at very low levels below the inflation rate, and the Fed kind of induced this era of financial repression or negative real rates. And so the question that I have and that I'm discussing with my colleagues is, will this regime bring with it inflation? And we know that cyclical inflation is happening. It has to happen. Just the base, the whole base effect of the CPI kind of guarantees that it will happen. But will it lead to structural inflation? And I don't know the answer, but
I thought you were going to give me an answer, Jurrien. Come on, man. Don't put questions out here that you don't have answers to.
But I'm just saying, if it does, it could change everything in terms of how we do it. The 60-40 stocks bonds correlation, growth to value could be structural instead of cyclical. So that's kind of the way I'm thinking about.
Wait, sorry. I want to back up and focus in on that. It could change everything in what way? I mean, do we need to, because I feel like folks like yourself are saying, well, we got to stick with the 60-40, things like that. So if we do get this package and we do get that return to full employment, what does that mean?
So if transitory inflation becomes entrenched, right, and we know the Fed is going to keep the Fed is trying to send the bond vigilantes back home, right? It's like, no, go, we got this. So the risk is, and again, I don't know whether this will happen. We obviously have strong deflationary secular, headwinds, technology, all that stuff. But 60-40 only works in a low inflation environment. If inflation goes up, bonds become positively correlated to stocks rather than negatively. And I'm talking about bond returns versus stock returns. And the whole point of 60-40, in the old days when interest rates were much higher, you would get diversification plus income. Now you're kind of just getting diversification. But if you lose that, we have to start tinkering with the 40 side of the 60-40. And, 60-40 has worked for the last 2 decades. So a lot of our industry is built on it. So it's a big existential question to ponder.
Yeah. Zach, I see you making some faces over there. What are your thoughts?
Yeah, I think it really is going to come down to whether or not this transitory inflation that we all know is coming, at least over the next couple months with respect to the base effects, as Jurrien mentioned, is really sustained. And it's hard to think of a time in recent memory where you had fiscal and monetary policy both so supportive of a higher inflation regime. So you do have that aspect, and on the other end of that spectrum, you have all of these deflationary or at least disinflationary pressures that we've seen for the past decade.
Right. On the one hand, on the other hand, but Zach, to Jurrien's point about the 60-40, does this, as you are a rate strategist, do you agree with what he's saying that we have to reevaluate that 60-40 portfolio?
Well, I think things are very different now, so it does require reevaluation. As we're calling the 10-year at 175 high right now. That's historically low, and you're not getting the type of income that you used to get from the 40 side of the 60-40 portfolio. So I think that deserves some reevaluation. But from our perspective, we think that you're going to get higher inflation this year, and it's going to be gradual. And when it comes to how that affects what the Fed does, they're going to allow higher inflation. And again, as Jurrien pointed out, they're really focused on eliminating any shortfalls from maximum employment. And I would even say they're taking it a step further in saying that this needs to be a broad-based recovery, and they're really focused on getting back to the broad employment across different demographics that we had prior to the pandemic. So I think that higher inflation is in the cards. Whether or not it's enough to change the Fed's stance is going to be something that we're focused on. We don't expect the Fed to begin tightening monetary policy in any way until early next year. We think that in early 2022 is a reasonable time for them to start tapering asset purchases.
Whoa. Hold on. Now you're making some waves, Zach. Early 2022 for the Fed to start. And do you mean tapering or do you mean raising rates?
Tapering. Raising rates are ways off, so thank you for catching me on that. We think a rate hike is certainly a long way from now, and when you think about how long the taper could take, I think the Fed outlined that they would probably follow a similar path that they did when they ended the final round of QE after the global financial crisis, which took about a year. So when we think about what that means for an eventual increase in the policy rate, I think it was about 2 years since they ended net asset purchases the last time around for them to raise the rate. And obviously the crisis back then was much different than what we've dealt with now. But we do think it will take some time after they end net asset purchases for them to hike rates. And really that comes down to their new longer run framework with respect to average inflation targeting and focusing on shortfalls from unemployment rather than simply deviations from maximum employment.
And Dion, I would just add to that. If you look at the narrow measure of unemployment, the U3, the gap between the U3 unemployment rate and what's considered full employment, what used to be called NAIRU, it's called the natural rate of unemployment now, or employment. That gap is only 1.7, and it's very likely to close a lot more tomorrow or Friday when we have the unemployment number. But the U6, which is the broader, that includes sort of disenfranchised
Right.
workers, that's still 6.6 percentage points. That's almost as bad as the worst part of the financial crisis 12 years ago. Now, it's closing rapidly, and like I said, it'll close more on Friday, but it's still a very large gap. And my sense is both the Treasury and the Fed, they're kind of looking at things almost through like an ESG filter, like a social justice filter. They want to bring everybody back in, and I think that's going to leave policy, both fiscal and monetary, much looser for much longer than it normally would in a typical cycle.
No, I agree with you. And I think the other thing you've got to look at is you've got to look at employment to population ratio. You've got to look at the total number of folks employed. And those numbers are looking really tough and not good, especially just because so many people have dropped out of the labor force that aren't being counted in that U3 number that you mentioned. I want to switch gears a little bit because it seems like you both are pretty bullish on the outlook and don't see inflation getting out of control. Is that right?
I think that's fair.
Yeah, I think that the Fed and the markets will look past what will very likely be, a shooting higher of inflation because of the base effects. But again, it's the longer term whether expectations get entrenched. That is kind of the genie that the Fed will not want to get out of the bottle. Although a cynical person might say that in a world where debt levels are high and rising rapidly, policymakers probably actually want and need inflation because demographically it's going to be harder to grow out of this debt than, for instance, we would have done after World War II. So maybe policymakers, they won't admit it, but maybe they're even solving for some inflation because it is one way to get yourself out of debt when you are pushing real rates below zero.
Yeah, I think the Fed would admit it, but I think they'd only say, we only want 2%. Anything, we want inflation to run a little bit above so we can hit our sustained 2% target and, getting into all the Fed speak. But I want to ask you too about the market. Because for a long time, and this is something I've been writing about in the Axios Markets newsletter, we saw through 2018, 2019, even a bit in 2017, a lot of people in the market were afraid. There was a lot of fear, and they were going into bonds, they were going into treasuries, money market funds. Even though the stock market was shooting up and up and up, you saw a lot more allocation to those safe assets. Over the past month, it seems like we've seen a complete reversal of that. Goldman Sachs is leading the charge. Everything's going to be great. 10% growth this year. Booming recovery. Everybody's moving into stocks. We're seeing record inflows into stock funds. And it seems like everyone is bullish right now. Jurrien, I want to go with you because you're the director of Global Macro. Is that something you're worried about? Just this change in psychology of everyone being very bullish?
Yeah, I'm not worried about it, at least not yet, and I'll explain why. So first of all, if you count the start of this bull market as March of 2009, to me this is a secular bull market.
Oh, whoa! We didn't have a bear. Wait, whoa! The bull market didn't end in March 2020, Jurrien?
No, I mean it cyclically it did. 35% drop. I mean, by any measure,
that's a pretty big drop.
I'm talking about secular bull market. Right.
Okay.
So
all right.
A long era of spanning several decades. We had that in the 80s and 90s. We had that in the 50s and 60s. So I'm viewing this as what happened with COVID was a cyclical bear market within a secular bull market. But the point I'm trying to make is that from that start until now, when you add up all the flows into stock funds and ETFs against all the flows into bond funds and ETFs, bond funds have taken in, I think, like $3 trillion, and stock funds and ETFs cumulatively since March of 2009 have taken in almost zero, because it left the financial crisis left such a bad taste in people's mouths. They shunned stocks. The Fed, of course, by doing its financial engineering, by buying up treasuries and QE, kind of forced people
financial
into the bond market to try to get some spread. But even for this cycle, during since the pandemic started, we saw that mountain of cash going into money markets, right? And we've all seen it, $1.2 trillion going in, and it was very slow to leave. And even now, money is coming into stock funds and ETFs. Money is coming back into bond funds and ETFs, I think mostly because of corporates and things, bonds that offer a spread. But stocks are barely beating bonds. And what's interesting is that in recent weeks, even money markets are taking more money back in. So right now, stock funds, bond funds, and money markets are all growing their assets. And that is a very clear sign that these are the stimulus checks being deployed into the markets, because usually one goes against the other. It's a zero sum, right? If money is going into money markets, it's leaving stocks. It's going into everything right now. But when I look at the stock flows, which have been robust in the last, 3 months or so, when I look at that over the long term, I don't think that these are bubble-like levels. And when we talk to clients, a lot of people did sell a year ago, and a lot of people have not come back yet. So we can talk about the speculation and the meme stocks, but that's like a different show. That's a different part of the sentiment structure. When I look at whether something is overvalued or overbought or overbelieved, I'm really looking at average or typical investors saving for retirements, not people speculating in the markets. And I am just not getting the sense that this market is kind of over and done.
It's frothy. Yeah. Zach, what about you? You're a rate strategist. What's your take?
Yeah, I think there are some great points there, and it really comes down to the fact that you have the Fed buying a ton of treasuries and agency MBS still, while at the same time you have a ton of money coming in from the fiscal side. And our economics team loves to point out this figure that they estimate there's $1.5 trillion in excess savings out there as a result of all of these different fiscal measures taken, and at the same time you have monetary policy also extremely accommodative. They expected that number could total $2.5 trillion by the third quarter of this year. So there is a ton of cash out there. And while you do see money going into bond funds and even back into money market funds, and you haven't seen all of the cash that went back in last spring come out, it's hard to argue that there isn't more cash to be put to work. Now, the one thing that I would say, given our outlook and how that might impact equity markets, we do expect yields to continue rising for the remainder of this year, perhaps taking a brief pause over the next couple of weeks, because we have seen a pretty tremendous ascent, certainly with the 10-year yield. But whether
Rising
or not
how high though?
So we think that 2% plus by the end of the year is definitely a possibility.
How plus, Zach? How plus? What are we talking?
I think it'd be hard to imagine us getting much above 2.25%, just given the fact that at a certain point, if you have rates rise too quickly, and to be honest, I would have thought what we've seen up to this point would have been too quick for the Fed to take. But Chairman Powell and all of the other Fed policymakers that have come out and made public comments have been remarkably comfortable with the rise in long-term yields, and they've argued time and time again that you haven't seen a material tightening of financial conditions, and they're not going to act to make monetary policy even more accommodative until you see that material tightening. So I think if you had, a 10-year at 2.5%, and that was happening over the next couple months, that would probably cause this material tightening that could cause a shift in policy, whether that means increasing the weighted average maturity of its purchases, so doing a pseudo operation twist type measure, or just increasing the amount of purchases outright. I think those things would become possible at this point, but the Fed has made it clear that they are comfortable with what we've seen. And really the reason that we think yields are going to continue to rise and the curve to steepen is you just have this remarkable amount of debt coming online. And that's even after kind of setting aside this infrastructure package. And we look for 2.8 trillion in net coupon issuance this year. So you take 960 billion of the Fed to take down, and that leaves 1.8 trillion for the market to digest. And if you think about those same numbers last year, Treasury relied very heavily on T-bill issuance, and there was this big inflow into money market funds to take down all the T-bills. Net coupon issuance, after accounting for Fed purchases, was negative to the tune of about 400 billion. So you have this huge shift in supply to coupons in the back end of the curve, given all of the increases last year. And we're saying, who's going to take down all this debt? And we think that that's part of the reason why you've seen yields rise up to this point, and that's a big part of the story that we see for the remainder of this year.
And so you think yields continue to rise to that 2.25%, and then the Fed kind of has to step in and act. And that'll be this year, is what you're saying, Zach?
Well, I think that if you were to hit 2.5%, something like that, in short order, call it over the next couple months, the Fed would act. But the type of the rise that we're considering, call it 2% by the end of the year, we think that's something that the Fed is clearly very comfortable with. That's only another 25 basis points from where we are today. And as long as the economy does reopen and we have these robust growth rates that seems like everyone is calling for at this point, we think the Fed will keep policy steady, allow that scenario to unfold, and then begin tapering in early 2022 as the economy is on much more solid footing and they just begin to very gradually remove accommodation.
Yeah, Jurrien, you look like you wanted to jump in.
I would just add, I think, so I agree. I have a very simple bond model based on nominal GDP, the Fed funds curve, and demographic trends that suggests 2% is the upper band. But I think a lot of it will come down to whether that rise to 2 or 2.25, as Zach mentioned, is coming on the back of rising inflation expectations or rising real yields. So if it's inflation expectations, I think the Fed is going to be pretty chill about it, because then by definition, real rates, at least on the short end, are going to go further negative, right? Which I think is what the policymakers need to see when you have such a large and rising debt. But if the next 50 basis points is all real yields, that's going to harken back memories to the taper tantrum in 2013, which produced a very sudden 150 basis points rise in real yields in like 6 weeks. I mean, that's a pretty big shock to the economy, to the mortgage market. So I think what is driving the yields will be very important to the Fed and will dictate whether they will be more forceful rather than just trying to jawbone, the bond vigilantes back home. So.
All right. Yeah, and the last question I want to leave you both with, Zach, I want to start with you, is just your outlook right now. I mean, like I said earlier, as we've been talking about, just about everyone's bullish. This big infrastructure plan has gotten, I think, anyone who wasn't bullish on the bullish train, except for those folks who are worried about inflation. What's your biggest worry as we look forward at the next, not just the near term, but the medium term? Because it seems like it's all clear skies as far as what I'm seeing in my inbox.
Yeah, I think, runaway inflation, and it's going to take some time to determine whether or not that's happening or possible, is a clear risk. And I really don't think that's certainly not our base case. I think it's possible, as we outlined all of the reasons why inflation could run away. If you have this tremendous amount of fiscal and monetary accommodation and yet another package on top of it to the tune of $2.25 trillion, whatever it may be, perhaps that is something that is, causes that outlook to be possible. We don't think
and don't forget, there's another one. There's another infrastructure bill coming after this one, or at least proposed.
Right. They could be splitting up the $3 trillion into, so that it does seem like there are a lot of things pushing toward that inflation that could get out of hand like we haven't seen in decades. I'd say that's a risk to our outlook, and that would cause, the Fed to maybe tighten policy very quickly. But, the Fed has really changed its approach to inflation, and I think you're not going to end up with a situation where they, raise rates so quickly that it stems off the recovery. But that's something we're worried about. And, the other thing is if economies aren't able to reopen the way we think, and the economy can't, all this pent up spending doesn't get released into the economy, then I think you could have a slower recovery than most people are anticipating at this point.
Can I just ask you really, really quickly, your big risk is more that the Fed tightens too quickly than that they don't, or that inflation does begin to rise and the Fed doesn't catch it? That's not something you're worried about.
I think that, the runaway inflation, if that were to happen and kind of wreak havoc on the economy and the Fed weren't to act, that maybe that's the bigger risk this time around because of their shift in approach to inflation and longer run framework.
Right.
And it used to be the other way.
Sorry, your take.
6 months ago, the answer to your question would be, I would be concerned that the rotation from growth to value, with the FANGs being such a big part of the market, that rotation would be happening in a down tape as opposed to an up tape. But we are seeing that the rotation is ongoing. It is happening. The air is being let out of those big growers, but it's not coming at the expense of the market, going down. So we're at all-time highs while this tape is broadening out, and that's a really, as a technician, that's a really good thing to see. So what I would be worried about now is I'm not worried that the Fed's going to normalize policy too soon. My timeline is a lot further out than Zach's, but that they just lose the narrative, lose control over the narrative. The Fed right now is saying, don't worry. If we see the whites in inflation eyes, we'll worry about it then. But I think the Fed's kind of a single mandate Fed right now, full employment for everyone. But the risk is that the market just won't let them dictate the narrative, and that not so much that inflation expectations go up too much, because again, I think that's indirectly something policymakers are even solving for, but that real rates shoot up too fast. I mean, obviously, a more robust economy should have higher real rates than a weak economy, so it all makes sense. Yeah. But the taper tantrum in 2013, a long time ago, didn't really affect the stock market so much because the market wasn't as growthy as it is now. But the market is a lot growthier now, by which I mean more dominated by growth stocks. So a sharp rise in real yields does affect valuation. It does kind of upset
the whole market
in that way.
All right. Zachary Griffiths, rate strategist at Wells Fargo Securities. Jurrien Timmer, director of global macro. Thank you guys both for being with us.
Awesome. Thanks.
Thank you.
Thank you.